Good morning, everyone. My name is Ezra and today I'm pleased to present our comprehensive acquisition and development strategy for 41 to 45 Ireland Street, Freeman's Bay. From the outset of this project, Jackson's core mandate has guided our analysis. The appetite for high return development is absolutely there, but under no circumstances do we want a mess. You want a clean, highly disciplined execution that maximizes capital efficiency without leaving behind long-term operational headaches. Our presentation today directly answers that call, laying out a clear, structured pathway to maximize the site's value while honoring your mandates. Let's look at the underlying real estate fundamentals. The property consists of a 636 square metre freehold corner parcel with a flat contour, currently holding a 684 square metre office and warehouse building dating back to 1980. It currently generates $184,000 per annum net, with fixed 3% annual growth, and was sold in March 2025 for $4.5 million. Crucially, the business mixed-use zoning allows for significant intensification, and the current lease includes a 12-month redevelopment clause. This gives us a highly flexible, unencumbered runway to clear the site when we choose. Location-wise, this pocket of Freeman's Bay is premium city fringe real estate. The site sits directly adjacent to the New World's Freeman's Bay supermarket and is just 350 metres from Victoria Park. With immediate CBD proximity, superior transit connectivity, and a doorstep link to the local hospitality and lifestyle hubs, this location is incredibly insulated from downside market risk and highly attractive to affluent end users. This site offers a powerful dual market strategic advantage. On the commercial side, we see a distinct flight to quality. Prime vacancy is low at 10.8% and dropping, while secondary vacancy languishes at over 22%. On the residential side, the metrics are even stronger. The local precinct rent sits at $725 per week, supported by a wealth profile where 65% of residents are professionals or managers. And the median personal income is $21,400 higher than the New Zealand average. This tells us the immediate catchment has the deep capital required to support premium residential product. Looking at the macro environment, our timing was optimal. The Auckland market is showing a clear upward trend, with median prices hitting a 2-year high of 1.03 million and a sales activity surging over 60% month on month. Crucially, interest rates are easing and sit at a 3.5-year low, approximately 6.16%. As borrowing costs trend down over our planning phase, buyer confidence will continue to build right as our finished units hit the market. On the global stage, easing supply chain volatility and stabilizing material costs are reducing development risk. As global capital flows migrate toward value-add strategies, prime, well-located city fringe real estate is seeing renewed momentum. Our position on Ireland Street aligns perfectly with this institutional trend. To find the highest and best use, we initially examined 6 potential pathways, including mixed-use redevelopment, commercial retail, air rights, refurbishment, land subdivision, and pure residential. Each was weighed against construction costs, revenue potential, and long-term complexity to filter out the strategies that would conflict with our operational objectives. We systematically triggered our long list down to a refined shortlist. We immediately crossed out commercial retail and land subdivision due to small-scale management complexity and messy physical constraints. Crucially, we also crossed out mixed-use redevelopment while high yielding, managing a split-focus asset with ground floor retail and upper-level residential creates an ongoing management mess that violates Jackson's directive. This leaves us with 3 highly clean, distinct pathways. This gives us 3 clear operational structures to test. Option 1, residential apartments, a 4-story high-spec residential building comprising 35 units. It represents a high-risk, high-return play. Option 2, refurbishment, upgrading interiors, building services, seismic and sustainability features for low to medium risk. Option 3, air rights sale, slicing off the vertical rights for 24 to 32 apartments to a third party while retaining the ground floor commercial space. Let's look at our financial performance, starting with option 1. This is a pure build and sell model. The numbers are exceptional. It delivers a strong 15% IRR and a powerful net present value of $1.5 million. It generates an absolute profit margin of $10.72 million on a peak equity requirement of $25 million. As you can see from the cash flow curve, capital drawdowns are deep in year 2 and 3, but the sales revenue in year 4 and 5 yields a highly positive correction. Option 2 represents our most conservative path, a deep refurbishment with a 10-year holding period. While it carries lower initial execution risk, it is the weakest performer on a time-adjusted basis. It generates an absolute margin of $8.4 million on $8 million of peak equity. But because that return is dragged out over a decade, its IRR drops to 10% and it returns a negative NPV of negative $972,000 against our hurdle rate. It simply ties up capital for too long with modest performance. Option 3 is our capital release model via an air rights sale. This option sits exactly at a competitive 12% IRR, netting a modest absolute margin of $1.18 million. Its core strength is risk mitigation. Because the vertical rights are sold off upfront, peak equity drops to a negative $3.44 million, meaning it requires zero vertical construction exposure from our side, and it is a highly viable fallback path, though it offers limited financial upside. When we visually stack these options side by side against our metrics, the outperformance is stark. Option 1 is our clear financial alpha, leading on both a value basis with a positive 1.5 NPV and a velocity basis with a 15% IRR. Option 2 loses value under our discount rate, and option 3 clears the bar but provides very little absolute wealth generation. Opening up the summary master ledger, let's verify the performance mechanics. Option 1 draws a total revenue of $37 million against costs of $26 million, netting a 41% margin on cost. Option 2 shows higher total revenue over 10 years at $17 million against lower initial costs, yielding a high nominal margin on cost of 96%, but fails on a time-adjusted NPV basis. Option 3 sits on a tight revenue of $7 million against a $6 million cost structure, yielding a 19% margin. The grid mathematically confirms that option 1 maximizes the value of our initial capital deployment. Based on this modeling, our definitive recommendation is to proceed with option 1. It comfortably outpaces the alternative pathways, and its massive $10 million profit margin provides an incredibly safe shock absorber against potential construction cost overruns on market shifts. Option 3 remains a highly secure corporate fallback at risk parameter shifts, while option 2 is officially removed from consideration. Let's look at the operational realities of option 1. The core advantage is a clean exit. We build, we sell, and we achieve full capital recovery within 5 years with zero ongoing tenancy management or body corporate entanglements. The primary challenge is the $25 million peak equity requirement with a multi-year construction cash drawn phase. However, given the strong demographic tailwinds of Freeman's Bay, this is a highly calculated risk by an exceptional margin buffer. To ensure the board has complete context on why we are declining option 2, while retaining the existing structure keeps construction risk very low and introduces modern ESG positioning, the downsides are too heavy. The 10-year capital lockup combined with a 95% vacancy disruption during construction results in a subpar 10% IRR that actively destroys value relative to our corporate capital hurdle. For option 3, the air rights sale, the pros are clear: minimal capital at risk and zero construction exposure. However, the cons are a permanent constraint, a minimal absolute margin of $1.18 million, deep dependency in finding an institutional-grade third-party developer, and a complete loss of vertical control over what is built directly above our ground floor asset. To summarize, our rationale for Jackson, option 1 is the single best fit for this acquisition. Financially, it stands alone with a 15% IRR and a $10.7 million margin. Strategically, it fulfills the highest and best use of the business mixed-use zoning by capturing premium residential demand. Operationally, it fully respects the no-mess mandate. It gives you a clean, singular development focus, a full exit within 5 years, and zero lingering tenancy obligations. It is a highly disciplined, profitable build and sell play. If approved today, our implementation timeline is highly structured over 5 years. Months 0 to 6, complete the acquisition and finalise legal frameworks. Year 1 to 2, lodge resource and building consents while initialising our pre-sales marketing campaign. And years 2 to 3, appoint our Tier 1 main contractor and execute the 2.5-year construction program. Years 4 to 5, complete construction, settle the title units with a modelled split of 45% settled in year 4 and 55% in year 5, and cleanly return all capital to the business. Thank you for your time this morning.